Welcome to the deep dive. So, we've pulled together a whole stack of transcripts from PepsiCo's recent Q3 2025 earnings call.
That's right.
And importantly, we're skipping the standard opening remarks from the CEO and CFO.
Yeah, we're jumping straight into the Q&A, the live session.
Exactly. Because that's really where management has to, well, face the music and answer the tough investor questions directly.
And our job today is to give you that shortcut. We want to help you understand the key takeaways, what management actually revealed about things like volume pressures, their innovation plans.
And really their whole strategic direction heading into 2026.
Right. We're trying to cut through the complexity, synthesize those answers, and really highlight the aha moments, especially where the company seems to be making big shifts.
These sources gave us a really detailed look at where the rubber meets the road. We're focusing on the numbers, the plans, the stuff they only reveal under pressure. Okay, let's unpack this. Maybe we can start with that immediate challenge.
Yeah.
Dealing with the top line, the volume stuff, and getting back to their growth targets.
Yeah, absolutely. So the first thing investors jumped on was this perception of volume pressure in the quarter.
Right. It looks like pressure across the board initially.
It did. But the first key insight here is that the story is really quite different when you separate beverages from the food business.
Okay, so how does that break down? What did the math actually show for beverages when you look closer?
Well, for PepsiCo Beverages North America, PBNA, the picture is actually pretty healthy. Yes, the overall reported volume was down.
Yeah.
But that was almost entirely because they divested, or rather changed the model for, their case pack water business. It's a technical thing.
Ah, so if you strip that out.
If you exclude that, PBNA grew volume in the quarter. And not just that. Major brands like, well, Pepsi itself grew volume, net revenue, and market share. So pretty strong.
Okay, so beverages are actually doing all right then. But the volume hit was real on the food side. Frito-Lay North America, PFNA.
That's where the impact was felt, yes. And management pinned that on a deliberate shift in their value strategy.
A shift. What did that involve? They moved away from deep discounts.
Basically, yeah. In 2024, they were doing these really deep but sort of isolated promotions on specific big brands.
Right.
Now they've moved to what they call an everyday low-value approach, spreading the value more evenly across all the brands, maybe less deep discounts.
And that hurt overall volume numbers.
It did, admittedly. But management was pretty clear that it led to much better revenue realization. They got more dollars per pound hold, essentially.
Why make that trade? Lower volume, but better revenue realization.
Right.
Why is that seen as better financially?
Well, there are a few solid reasons, especially thinking about valuation. First, it makes profits less volatile, right? You're not just chasing these huge, short promotional spikes.
I'll make smoother.
Second, it probably helps brand equity long-term. You're not constantly training consumers to wait for a deep sale.
Good point.
And third, it likely simplifies things behind the scenes, supply chain, logistics. Less complexity usually means lower costs overall. So yeah, it's often seen as a healthier way to manage the business.
That makes sense. So if they're making these kinds of strategic tweaks, how confident are they feeling about getting back to their official long-term growth target?
Yeah.
Their algorithm.
They seem remarkably confident. They said they see a clear line of sight to hitting that algorithm, which is usually, 4% to 6% net revenue growth throughout 2026.
Throughout 2026. Wow. Where's that confidence coming from?
Primarily, they kept saying from being brilliant at the basics, especially fixing the service level problems they had earlier.
The execution issues.
Exactly. Yeah. They admitted things were rocky before, but now they're reporting service levels way up, like 97, 98%, which is very high.
And did we hear any real-time proof that this fix is actually working now?
We did. Specifically for PFNA, the part that took the biggest volume hit earlier. They expect it to be nearly flat in Q4.
Okay, stabilizing.
Even better, they pointed out that in the last 4 weeks of the reported period, PFNA actually saw growth. So that sequential improvement is the key signal. It shows better execution is translating directly into sales.
Got it.
Oh, and one other point on global, they mentioned the Q3 international slowdown was mostly weather in some big markets, and September actually bounced back strongly, putting them back on track for that mid to high single-digit growth globally.
Okay, so the basics are getting fixed, the trajectory looks better, but fixing operations is one thing. Long-term value really comes from innovation, right? Right. And this part of the Q&A felt intense, a real sense of urgency to modernize what they offer.
Oh, definitely. Here's where it gets really interesting. It's not just one thing. It's a super aggressive, multi-pronged overhaul they're pushing.
Like what? Big brand relaunches.
Huge ones. They're relaunching 3 top-tier brands. Lay's, Tostitos, which is happening like right now, and then a massive Gatorade relaunch coming in Q1, Q2 of next year.
Gatorade 2, what's the angle there?
The focus seems to be on communicating superior hydration, really hammering home the science, the electrolytes, basically proving its effectiveness to grow the whole category, not just defend share.
Okay. And on the drink side, Pepsi itself got a relaunch a while back. How's that going?
Really well, apparently. Driven a lot by zero-sugar versions internationally, but here in the U.S., they're pushing that food deserves Pepsi idea.
Right, linking it to meals.
Right.
Which, feels a bit counter to the whole less sugar with meals trend, doesn't it?
Yeah.
Are they sure that's the right horse to back?
That's a fair question, and their confidence seems tied to where they're focusing that message. They pointed out the away-from-home channel, restaurants, convenience stores, venues.
Places people are already eating out.
Exactly. And that channel is growing way faster, like 2 to 3 times faster than traditional retail. So it's the perfect place for that food deserves Pepsi message, pushing fountain drinks, cold cases, where the margins on meals are higher anyway.
Okay, focusing the investment makes sense. But what about completely new stuff? Catching the next wave of health trends. I heard this quote, fiber will be the next protein.
Yes. They really leaned into that. They see fiber as this major gap in the American diet and therefore a huge opportunity. It requires transforming the portfolio.
And protein is still huge for them too, right?
Absolutely massive focus. They're relaunching muscle milk cleaner ingredients, no artificials, new packaging. They're adding protein everywhere. Starbucks drinks with protein, Doritos protein snacks, Quaker protein cereals.
Doritos protein, wow, okay. But the thing that really jumped out was this new Propel product they mentioned.
Yes, the one for GLP-1 consumers.
Right. A specific drink, high-fiber protein electrolytes aimed at people using drugs like Ozempic or Wegovy. For listeners maybe not following pharma, what are GLP-1s and why is this such a big deal for a company like PepsiCo?
Sure. So GLP-1s are this class of drugs, Ozempic, Wegovy, Mounjaro, primarily used for diabetes and increasingly weight loss.
And they work by suppressing appetite. Right. People eat less.
Significantly less. But here's the thing. When you're eating much less, you still need essential nutrients, protein to maintain muscle, electrolytes for hydration, and fiber for digestion and satiety.
So there's a nutritional need created by the drug.
Precisely. And PepsiCo is jumping on this. They're actively creating specialized products like this new Propel to meet the specific needs of this rapidly growing group of consumers. They see it as a fundamental shift in dietary patterns, not just a fad.
That is really forward-thinking and aggressive.
Yeah.
But it sounds expensive too. Reformulating everything, getting rid of artificials, using pricier things like avocado oil in snacks. How do they decide whether to build this stuff in-house versus just buying a company that already does it?
Good question. They talked about that. They said they try to leverage their existing platforms first. Muscle Milk and Propel relaunches are examples of doing it internally.
Okay.
But if they need to move really fast or get immediate scale in a totally new area, that's when they turn to M&A. They mentioned recent buys like Poppy, CIA, Sabra, Leninu, basically using acquisitions as accelerators for this portfolio transformation.
Okay, so you've got this huge push for innovation, often with better, maybe more expensive ingredients.
Yeah.
That leads straight to the next big investor question. How do you protect your margins? Doesn't a higher cost of goods squeeze profits?
Yeah, that question came up directly.
And did they basically admit margins might take a hit in the short term?
Nope, not at all. Quite the opposite, actually. They expect margins to keep improving overall.
If the ingredients cost more?
The key, they argued, is that this kind of innovation is designed to be accretive, meaning these higher quality, cleaner label products can command a pretty significant price premium.
So the price increase more than offsets the cost increase.
That's the plan. The value perception is higher, so consumers are willing to pay more. Price realization goes up.
Okay, so pricing is part of it, but they're also tackling costs internally, right? They talked about major interventions, especially in the Frito-Lay, the PFNA, fixed cost structure. What are they actually cutting or changing?
Yeah, they detailed 3 main areas for right-sizing PFNA. First, closing down older, quote, least efficient manufacturing plants.
Okay, getting rid of outdated facilities.
Exactly. As they bring newer, more automated, higher capacity plants online elsewhere, these older ones just aren't needed. It's about optimizing the whole network, not just trimming a bit here and there.
Makes sense. What were the other 2 levers?
Second was rationalizing their warehouse network. They see opportunities there thanks to more automation, but also, interestingly, Potential to combine some logistics with the beverage side of the business, PB&A.
Synergy between snacks and drinks warehousing.
Potentially, yeah. And the third lever was right-sizing the go-to-market structure, basically, the sales and delivery workforce, scaling back some of the extra labor they had added when the labor market was really tight a couple of years ago.
Okay. That idea of combining snacks and beverages logistics-wise,
Mm-hmm.
does that tie into the bigger One North America strategy we've heard about before? Are they still pushing towards merging those operations?
They are still testing aspects of it, yeah. Specifically in Texas, where they said the market conditions are kind of unique for a test.
But it's not going to be a nationwide merger.
No, they were pretty clear on that. Management insisted the final answer won't be some one-size-fits-all merger. It has to be much more nuanced, market by market. It depends on things like their snack market share versus beverage share in that specific region, how complex the retailers are there. It's complicated.
Got it. And maybe the biggest structural question of all, refranchising. Spinning off parts of the business, like bottling. Activist investors love suggesting that. What's the latest thinking there?
They gave the standard answer first, open to all ideas that create shareholder value.
Of course.
But their core stance seems to be that they want to optimize the entire PepsiCo P&L, not just carve off one piece. They feel they're solving for future demand trends, like dominant retailers, online ordering, pickup and delivery, and that having scale, technology, and control across the whole system gives them the best levers to pull right now.
Okay, let's shift focus a bit. Look internationally. The Q&A gave us a pretty candid snapshot of the global consumer, didn't it?
It really did. And the main theme, pretty much everywhere, was that consumers are feeling stressed. They're being very choiceful about where they spend their money.
So even though the Q3 slowdown had some weather impacts, the underlying pressure is real.
That's the sense, yes. The stress is structural.
Were there any specific geographic callouts? How are different regions doing?
Yeah, they gave some color. China was mentioned as stressed. India saw some local issues, weather and competition, but the growth trend is still there. The Middle East, interestingly, is feeling pretty good.
Oh.
Eastern Europe is actually doing better than Western Europe right now. Brazil continues to be a powerhouse, close to double-digit growth.
Mm-hmm.
And Mexico is, as usual, sort of tied to the U.S. economy via remittances.
Right. Okay, if we connect this to the bigger picture, beyond the immediate stress or weather effects, what did management identify as the big universal structural trends changing consumer behavior globally, the long-term shifts?
Yeah, they zeroed in on three big ones that are really shaping their strategy 2030. First, no surprise, is the huge shift to digital purchasing, just fundamentally changing how people buy everything, how it gets delivered.
Okay, digital. What else?
Second is the rise of the informed consumer. This is a global secular trend. People are paying way more attention to ingredients, demanding clean labels, thinking about the type of food they're eating.
Which directly fuels all that innovation and brand relaunching we talked about earlier.
Exactly. It's a major driver. And the third big structural trend is affordability and value. With fixed costs of living rising pretty much everywhere, household budgets are stretched. So the need for value, for sharp price points, for different pack sizes, that's not going away. It's a constant pressure point.
These big structural shifts definitely need strong leadership. And that brings us to the CFO change they announced. Jamie C. is retiring after 33 years. Wow.
Yeah, end of an era there.
But the replacement, Steve S., is an external hire. And notably, he's coming from their largest customer. Why go outside the company, and specifically to a giant retail partner like Walmart, for that role?
That seemed very intentional. The message was clear. They wanted a leader deeply experienced in the complexities of modern retail, the supply chain dynamics, dealing with huge commercial partners.
So it signals a focus on execution with retailers.
I think so. It suggests they're prioritizing that external perspective, someone who understands the customer side intimately to help execute Strategy 2030, especially around things like technology, digital fulfillment, and just optimizing how they work with these increasingly powerful retailers.
Okay. And finally, we have to touch on the activist investor angle. Elliott Management took a stake, pushing for changes to boost the stock price. Management called the interactions constructive and collaborative. But if Elliott's main ideas, portfolio changes, simplification, cost cuts, were supposedly already part of PepsiCo's Strategy 2030, where's the actual disagreement? What's the tension?
Yeah, that's the key question. The core tension seems to be around the urgency and the accountability for improving the valuation. Both sides agree the stock is undervalued and needs action.
What's about pace?
Pace and perhaps specifics of execution. Management is essentially saying, trust us, we have the right long-term plan. Elliot saying, that's great, but we need to see results faster and maybe prioritize differently to unlock value now. The constructive part is that they seem to agree on the strategic pillars. The ongoing dialogue is likely about the how fast and aligning on any remaining differences to get that share price moving.
Okay, so putting it all together, what does this Q&A really tell us? What does it all mean for you, whether you're an investor, just a consumer, or following the industry?
Look, I think it means PepsiCo is trying to pull off two massive, really complex transformations at the same time, and with a lot of urgency. It's quite a balancing act.
Two tracks. What are they?
On one track, you've got this intense push to accelerate organic growth that involves fixing the basics, like service levels, but more importantly, this huge portfolio transformation. They're aggressively chasing growth in areas like away from home, protein, fiber, and even these niche but potentially huge markets like products for GLP-1 users.
The innovation track.
And on the parallel track, they're doing deep cost transformation, right-sizing their physical assets, closing down old plants, trying to leverage technology and maybe some synergies to really optimize their P&L.
So growth through new stuff and efficiency through restructuring.
Exactly. And both are critical. They need both to deliver on their growth algorithm and meet the demands of this global consumer who's, stressed but also more informed and demanding than ever.
Which leads us perfectly into our final thought for you, the listener, to maybe chew on. Management kept bringing up fiber as the next protein, and they specifically mentioned developing products for GLP-1 consumers.
Yeah, it was striking.
So if this is a real structural shift in health and diet, not just a temporary trend, how fast will other big CPG companies, maybe ones that are slower moving, be forced to react? And what happens to the parts of their portfolio, like maybe core sugary drinks that can't easily be reformulated for high fiber or protein? Is PepsiCo's speed here actually creating a lasting competitive advantage in this emerging health landscape? Something to think about.
Definitely something to watch. Thanks for diving deep into the Q&A with us today. We'll see you next time.